Hello again, traders. Duane Shepherd here once again from DRFX, Swing Trading Mentoring. Going to be taking a look at a recent trade that was made on my live account with FX Pro on the Aussie Kiwi dollar pair, which provided a rate of return of 3.51%, as you can see here, in just under 20 hours, in providing a trading gain of 28 pips. So I'm going to be taking a look at the main technical factors which supported this trade, with a focus being on the bull crown inverted head and shoulders market pattern, which is very popular across the currency market when it comes to transitions from downtrends to uptrending markets. Also going to be taking a look at the importance of never monitoring our trades, which is a bad habit that can lead to a lot of self-sabotaging behavior and which can ultimately compromise our long-term profitability. So bull crown, head and shoulders pattern, as well as the importance of never monitoring our trades are the two main factors that I'm going to be taking a look at, which supported the profitability of this trade setup. Now, as you will see on my website, the main approach that I take to trading the currency market is to use Japanese candlestick signals, trend lines, and consolidation patterns to identify market direction and trading opportunities on the daily chart and the forward charts. So first of all, we identify whether or not the market is trending or whether it is moving within consolidation, and then identify a trading opportunity to take advantage of that setup. So once the market direction has been identified on the daily chart and the 4-hour chart, we then go down to the 4-hour chart where we would enter the market to take advantage of the trading opportunity using the tools of Japanese candlestick signals, trend lines, and consolidation patterns. Of course, no trade is complete without a strong stop loss area. And so what we do is to use the same patterns that are provided by the 4-hour chart in the form of the highs and lows of candlestick formations as well as trend lines to place our stop loss at these areas, which will be far enough to withstand temporary pullbacks until our trading target has been hit. Now, in terms of our trading targets, what we do with the use of these candlestick patterns on the daily chart and the 4-hour chart is to target trading gains of between 50 pips and 70 pips within a 24-hour holding period. What I found with the market is that once it provides us with these types of trading opportunities of between 50 pips and 70 pips, and in some cases between 20 pips and 30 pips as well, these types of trading opportunities, once they're strong enough, they generally hit their targets within a 24-hour holding period. So this helps us to establish a parameter in terms of the maximum time that we're going to be holding our trades, so that we're able to avoid the pullbacks and the volatility that can take place by holding our trades for much too long. So this is a general setup in terms of how we target trading opportunities in the currency market, using the daily chart and the 4-hour chart to identify market direction and trading opportunities, and then aiming for the most part, trading gains of between 50 pips and 70 pips within a 24-hour holding period. Now, this was a setup on the 4-hour chart of the Aussie Kiwi dollar earlier this week, where what I identified was this trading opportunity where the market was providing us with this bullish signal that would take us up towards this resistance boundary at 1.0792. So the market had transitioned from a downtrend to an uptrend, U-turning at this area here at support, breaking above this downtrend line, and providing us with this entry opportunity as part of this new trend direction. So this was a target that was set with a stop loss placed below the candlestick formation. And as you can see here, the target was eventually hit within 20 hours following this temporary pullback that took place at this area here. So the market, as you can see here, rallied immediately following entry in response to this bullish engulfing candlestick formation. It then pulled back temporarily, which, as I will mention later on in the video, would lead to a lot of panic if you had actually made the decision to monitor your trade, which is something that we should never do. It pulled back temporarily, but eventually U-turned because the general bullish momentum of the market was much stronger than the build-up of selling pressure that was taking place at this area here. So the market took 20 hours, 1, 2, 3, 4, 5 4-hour candles to hit our target, which was within the 24-hour holding period, which is set for these types of trading opportunities. Now, we're going to be taking a look at the bull crown head and shoulders pattern, inverted head and shoulders pattern that supported this trade, which is a very popular market pattern that you will see across the currency market. Now, what takes place is that in transitioning from a downtrend to an uptrend, the market will form one last setup, which takes the form of this left shoulder or the left tip of the formation. It will then continue in the existing trend direction before U-turning to create the head or the crown of the setup, and then rallying to start the movement in the new trend direction. Now, as part of the new trend direction, it will form its first setup, which will represent the right tip or the right shoulder of the formation, before continuing in the new trend direction and providing us with additional entry setups. Now, for the most part, in most cases, this is where we would enter the market to take advantage of the new trend direction. However, if the signal provided by this first setup is weak, then we will always have the option, or we should look out for the option of entering the market at another setup as part of the new trend direction, which has a much stronger signal compared to the one that was given at the first setup here. So this is a general format and structure of this transition market pattern that will allow us to take advantage of the formation of the new trend direction, allowing us the possibility to enter the market at either the first setup or at additional setups that are formed along the way as part of the new trend direction. Now, taking another look at the setup here on the forward chart, you can see here that the market formed this last setup as part of the previous downtrend. It then continued bearish for a little while before U-turning at support and then rallying to break above the downtrend line before providing us with the formation of this right tip of the formation. Now, as you can see here, the market did provide us with this bullish signal above the counter trend line setup, this red line here, but the signal was much too weak to actually justify risking it. Even though, as you can see, the market eventually responded to this signal. However, the market did provide us with a second opportunity as part of this new trend direction in the form of this bullish engulfing candlestick formation, which, as you can see, was much stronger with a much larger bull candle compared to the one that was formed at this area here. So this was deemed to be a better trading opportunity with a greater level of certainty. And so what we did was to enter the market at the close of this candle, placing our stop loss below the formation and targeting a trading gain that will allow us to targeting this resistance area at 1.0792, which we would aim to target in capturing a trading gain of 28 pips and a rate of return of 3.51%. So this was a setup. This was an entry which was supported by this bull crown setup, one of the very popular market setups that tells us that the market is transitioning from a downtrend to an uptrend, and we can either enter the market at the first setup as part of the formation of the right tip, or we can enter at additional setups that are formed along the way that are much stronger and give us a much higher probability of a profitable trading opportunity. Now, the next important thing that related to this trade, which is very important when it comes to trading the currency market, is that we should have the discipline to never monitor our trades after we have entered the market. Now, it is very tempting because we're trading with real money to always want to ensure that the market is going to be heading towards our target because of the fear of a loss from the trade from this currency market. I mean, after all, this market has a high failure rate of 95%, and so given that level of difficulty, there is an understandable level of stress and anxiety when it comes to trying to trade the currency market. However, what I found is that because of the natural nature of the market to wave and to move move up and down and move sideways and even slow down before actually hitting our target, and because that type of movement generally tends to have an emotional effect on us, the better decision is to never monitor our trade, because we can make the wrong decisions when we see these temporary pullbacks taking place. So what I highly advise you to do is to choose a trading platform that can provide you with email alerts telling you when the trade has been closed, such as FX Pro or any other trading platform. Or what you could do is to configure your trading platform so that when you're checking on the trade, you do not see the floating profit or the chart of the trade that you're actually in. What you can do is to configure the platform so that all you see is that the trade is still open. And then once you see that, then you can close the trading platform and check back at a later date to see what has taken place with the trade. So once you're not able to see the floating profit or the chart of the trade that you're in, it will help you to maintain the discipline of staying in your trade, which will avoid the bad habits of closing your trades too early because of temporary pullbacks, which will ultimately compromise your long-term profitability. So taking a look once again at this trade that we did here. So entry took place at the close of this candle, and as you can see here, if we had monitored the market, then we would eventually be seeing immediately the market responding bullish to the trade that we had made. So as you can see here, the market went very close, actually hitting our resistance target within a few pips. But instead of hitting our trading target at this area, at this candle here, the market temporarily pulled back, and it almost took out this bull candle that we had entered in. So if you had entered the market and you were looking at the trade, you would have been excited at seeing the prospect of the market hitting our trading target almost immediately. But then you would have gone through a roller coaster of negative emotions and panic as you started to see the market pull back and take away our trading gains. Now, as I said before, this is a normal pattern that takes place when it comes to trading the currency market, especially when it comes to trading so close to these resistance and support boundaries. Now, as you know, resistance and support areas tend to eventually have a build-up of opposing positions, which will exert an opposing pressure on the trade that we're in. So as we get closer to resistance boundaries, for example, you will inevitably meet up on a lot of opposing selling positions that have been open here. And so this type of pullback so close to resistance is something that is very common when it comes to the currency market. So this pullback is a natural market reaction that takes place at these areas here. And so, however, if you had monitored the market, you would have been tempted to exit the trade too early because of how deep this pullback was. So that is why it is very important to avoid monitoring the market, because we could have easily exited the market here, preferring to exit at a smaller loss compared to the larger loss that we would have incurred if the market eventually hit our stop loss. But once your stop loss is placed at the right location on a forward chart, in this case below the formation of this candlestick formation, then your trade will be protected and you will be able to withstand these temporary pullbacks. So as you can see here, the market eventually U-turned and eventually took out this temporary pullback and eventually hit our trading target, because the general bullish momentum of the market was still much stronger than the selling pressure that was taking place at this area here. So this is why it's very important to not monitor our trades, because of the possibility that the market can provide us with temporary pullbacks that can tempt us to exit our trades much too early and ultimately compromise our long-term profitability. So as you can see here, we would have exited the trade. If we had exited the trade at that pullback area here, at that pullback, we would have foregone this very nice trading opportunity that the market provided us in the form of this rate of return of 3.51%. So once you have a good trading strategy that is reliable, and you know for the most part that the market will take a certain number of hours or even a certain number of days, depending on your trading strategy, then you have to assume that the market will hit your trading target within that established holding period. And so there's nothing that you can do until your trading target has been hit. The market will always move in a sideways pattern and sometimes slow down and pull back. But this is the natural dynamic of the market, and monitoring the market will only lead us to be tempted to interfere with that market dynamic and compromise our long-term profitability. So once you stick to this discipline of staying in your trades and not monitoring your trades, then you'll be able to maximize on the trading opportunities provided by the market and capture trading gains of between 3% and 5%, which is the range that I aim for with my trading strategy. And once you're able to capture these types of rate of returns on a regular basis, then these are the types of returns that are possible for us over both the short term as well as over the long term. So that's it in terms of this example on the trade that I made on the Aussie Kiwi dollar. A strong rate of return of 3.51% captured within the 24-hour holding period that is set for my trading strategies. And a very great example of how we take advantage of bull crown setups, otherwise known as head and shoulders patterns, inverted head and shoulders patterns, as well as the importance of never monitoring our trades because of the possibility of being tempted to exit our trades too early because of the temporary pullbacks that take place from time to time. So if you have any questions, as usual, you can email me at shepherdduane@gmail.com. You can also check out my website, swingtradingmentoring.com, as well as my Instagram page at drfxtradingboss, where you'll find a description of the trading methodology that I use, which is based on Japanese candlestick signals, trend lines, uptrend lines and downtrend lines, as well as consolidation patterns, which are the main tools that I use in identifying market direction and profitable trading opportunities. In using these tools, and as well as a part of my mentoring service, we're basically going to be solving the 5 main challenges that face us when it comes to trading the currency market. The first is that we have to ensure that we're able to correctly draw the setup that is being formed and being presented on the currency pair that we're trading. We also need to ensure that we're trading the right signals and avoid the false signals that the market provides us from time to time. We also need to ensure that we're able to protect our stop loss, protect our trade with the right stop loss that is far enough away from our trade that will allow us to withstand temporary pullback, such as the one that took place on Aussie Kiwi dollar, until our trading target has been hit. So we don't want to be stopped out too early and miss out on profitable trading opportunities that the market provides us every week. We also need to ensure that we make the decision in terms of whether we exit the market just ahead of resistance or support, or whether we exit the market at these boundaries. This is something that you also learn that is very important to know, because sometimes the market will not always hit our resistance or support targets. So once we know beforehand, based on certain patterns that the market provides us, then we can make the right decision in terms of exiting our trades at the right area. Also need to ensure that we're aiming for the right pip targets and that we set a holding period, which in this case, in terms of my strategy, is a 24-hour holding period, which will ensure that we're able to maximize on the trading opportunities provided by the market on a short-term basis, while at the same time avoiding the pullbacks and the volatility that take place by holding our trades for much too long. So again, you can check out my website where you also find a description of the trading manual that is used, which forms the basis of my trading methodology and how we use candlestick patterns, trend lines and consolidation setups to identify trading opportunities. You'll also see a description of the video lessons, as well as the trading signals that are formed, or the trading signals that I provide as part of my mentoring service over a 3-month period, as well as over 6 months, which includes VIP mentoring service, which includes a VIP mentoring service of live video interacting chart analysis, which will allow you to more clearly understand the methodology and how it is applied to live market scenarios. So until next time, traders, happy trading and all the best.